Hey, good morning, Making Moves family. How are you guys? Tim Vest, what's up, my man? How you doing today?
Not too bad. Can't complain. I'm breathing above ground and I'm vertical, so that's good, right?
Yeah,
Uh,
yeah. Being vertical is a good thing. Well, unless you're taking a nap, then being horizontal is all right.
yeah. So
Well, hey, all right. So, we are just about what 3.5 weeks, maybe 4 weeks out from our Porsche event, the race cars and real estate event, November 18th and 19th. We're doing that down in Atlanta at the Porsche Driving Experience. We're gonna have some awesome speakers there. Tim and I are gonna do like a panel type setup and have some discussion. Sam Silverman's going to be there talking about raising money from investors and setting up a fund and how he's been able to find success the way that he's been able to over the last geez, I don't know, 14, 15 months or so. And Tim, why don't you tell us about what Mike Ely's going to talk about? Because I know that you're super close with him.
yeah, man. So Mike's coming up to or coming over and down. I suck with geography, guys. Mike's coming over to chat with everybody, kind of about what he's done in his career. That'll involve some capital raise as well, guys, and how he went from basically nothing to where he is today. If you guys haven't read his book, Broke to Millions, I recommend it. And hey, guys, one of the things that I would absolutely show up for is Tim and I were actually having this conversation the other day. It was like, how many guys have managed through
Mm,
a down market cycle? Well, here's your chance to get in front of one.
yeah.
Mike Mike was doing this in 1999. He was doing this in 2001. He did this through 2008 and 9. He's been through the cycles, folks. So if you want to get in the room with a guy that can tell you how to manage this your chance.
No, that's exactly where the inspiration of what we wanted to talk about this week came from. Was we have this conversation all the time of what do you do during down markets and how do you capitalize on it? Because everyone is talking about the price reductions that are coming and the ever increasing rate hikes from the Fed. I actually saw something on Twitter this morning and yesterday about they're calling it Fed Day, which is I think 8 days away now. So there's like a counter going around on Twitter with calling it Fed Day for the increase in the rates. But people keep asking us, what do you do during the down market and how do you capitalize on it? And like truthfully, I've never been through one. When I had graduated or when I was in college was in 2008 through 2012. I didn't really know what was going on in the real estate market. So what I'm doing is putting other people that know how to do it better than I do in the room so that I can have conversations with them and ask them from their experience, what do I do in order to protect my downside here? Obviously, the name of my company is Upside Capital, and I got that name from Sam Zell's book. Actually, I was reading it, and he's talking about if the downside is limited and measurable, and the upside is substantial, do the deal. Well,
Yeah.
right now, I'm learning about how to measure and mitigate the downside risk so that we can make sure that all of our investments have upside potential to it.
Yeah, yeah, really good point. And hey, guys, like, so I was around doing stuff then. However, I didn't manage through. I didn't have properties that I managed through. I was on a bad side of 2008 and 9, so I can tell you what to do from a lending standpoint and some of the mistakes that I made back then. I can absolutely share that, and I think you guys know I'm pretty transparent about that. But I didn't, to Tim's point, I didn't own property coming out of 2009 for many reasons. Uh, you know, we laugh about
Let's
it
not
now.
make that mistake again, huh?
Yeah, yeah, yeah. We laugh about it now. So I
Yeah,
could tell,
yeah, yeah.
so I can tell you those mistakes to avoid. But I didn't manage property through 2009 and 2010, and honestly, try to go find somebody who did.
hmm
That's still around doing it today.
You don't actually take that back. You don't need to go find somebody that has come to our Porsche event, come to the race cars and real estate event, November 18th and 19th. You can sit down and spend 2 days with us and Mike Ely and everybody else in the room that's going to be talking about the down market, how to mitigate the risk, and how to capitalize on it. So,
Yeah, you just
without going too much into that.
yeah, you got me there. You preempted me there. That's kind of where I was going, man. Like,
Yeah, sorry. Yeah, yeah. So I was just got not just trying to go right to it. So,
yeah,
all right. Yeah, so yeah, November 18th and 19th is $3,000 a ticket. All meals and everything are included. Just get there and pay for for your hotel. We have a room block that's listed on the website. That rate expires, I think, on the 28th. So if you're thinking about coming, buy your ticket and book your room, or at least reserve your room now, so that you can get the discounted rates, like $150 a night or something, and it's like walking distance to the track. Everything's right there. It's a really great location, and it's going to be a really good time. Oh, hey, Dan Tollin's going to be there. Man, they're going to have to get you an XL 911 Porsche. Sorry, you don't know Tim Best. You don't know Dan Tollins. Dan Tollins is like 6'6", and he's a big dude. And it's, I think he played football. It might have been a linebacker or something. He would crush you in football, I guess, if he could catch you.
Oh, he can catch me. I'm way slower than I was when I played. I think my daughter beat me in the last 40 that I ran. So there you
Mm.
go, guys.
Yeah. All right. Well, let's get into it today. So we're talking about the down market. News headlines all over the place, Twitter feeds, tons of discussions, Facebook posts, YouTube videos. Everywhere you look, it's people talking about the fear right now, talking about how the markets are getting so bad and how things are only going to get worse. And I agree, things are going to change. We're not going to see the wind in our sails as we have had the last 3, 4, 5, 6 years, especially the last couple of years. So it's important to talk about what we're seeing in the market and how that's affecting our underwriting and what's that doing in terms of our conversations with brokers and sellers. And Tim, I want you to talk about this experience that we've had with this one seller that we ended up walking away from this deal. And ultimately, I think it's because of the change in the market. But I wanted you to talk about that a little bit and just kind of go into your mindset and your framework around what you did and why, because of the advantages that we have in the market right now.
Yeah, so kind of what we're talking about here is, for the last 2 years, there's been no opportunity. I mean, you could walk away from a deal in the last 2 years, but you were definitely going to lose something. And in this particular case, we started to see a real market shift. This was one of our first ones where we started to see a real market shift. Our capex budget just it doubled, right? Like basically doubled. And this was not a small deal. The capex budget wasn't insignificant to begin with, and so when it doubled, it became even more significant. So we went back and we started negotiating that. And the fact that, well, one thing, the fact that they were even willing to pull up to the table tells you something.
Mm, oh, good point.
That was something that just wasn't even an option, the last year. Guys are like, "Wait, your capex changed? That's your problem. Give it back. I'll put it back on the market." That kind of thing.
Mm,
Um, they came to the table. They were willing to talk. Now, some of their negotiations were a little on the low end. We'll just put it that way. But at the end of the day, we did kind of get close, very, very close to what we were asking for. But there were a number of things that kind of made me go and made our team go, red flags, right? Things that we were thinking maybe we did not find, even though our due diligence was very, very thorough. Maybe there were some things there we didn't find. So anyway, where Tim really wanted to go with this, and I'm just rambling, was, we backed out. Well, for the next 2.5 weeks, the seller kept coming back to us and asking us to come back to the table. Um, that's been unheard of, absolutely unheard of in the last 2 years. And guys, that's a sign that this market is shifting. Nobody wants to put their asset back on the market. If you do, and somebody who's just looked at you right now and said, "Fine, I'll take it back to the market," please comment and let us know, because I think that is the exception rather than the norm. But yeah, man, things are changing, and sellers are becoming more agreeable to negotiation. Even when you walk away from the table, they're willing to kind of chase you for a little while to see if you come back. And
mm.
here's one thing I'm going to say to that though: don't make that a standard. Don't
Yeah.
be the guy. Don't be the guy who, in my opinion, don't be the guy who has a reputation for retrading constantly. That's not what we're talking about here. We're really trying to talk about, I think things are coming back to a time when sellers and buyers need to be a little more agreeable on both sides, um, which is honestly the kind of goal for me usually is, let's do something that works for both of us, if possible, and everybody walks away happy. That's been tough in the last 2 years, and we're starting to see that shift for sure.
Yeah. Yeah, I think it's really big, right? That's a huge statement of somebody keeps chasing us in order to buy this deal because market sentiment has changed. There's not that many buyers out there. If you have, we did a live show a couple weeks back with Kyle Chase, and we were talking about from his perspective as a broker, what are you seeing in the market now with the change in pricing and the change in rates? And he said there's less offers. It's funny to say, actually, there's a couple other huge brokerages that known for doing big deals have been coming to me with 12 unit deals. And they're begging for an offer, just like they say, hey, put anything on paper and give me an offer so that I have something to present to the seller. And I think what's happening there is they're basically CYAing because they said that in their contract that they will bring a viable offer to the table. So they're trying to fulfill their contract needs of by doing that. So that has opened up a large opportunity there to make multiple offers. And we literally just went through this last night or yesterday with our coaching group, and we were talking about how are we making multiple offers? And I went into the mindset of why I'm making multiple offers, how I'm structuring multiple offers, and ultimately I want them to pick a certain offer that's the most beneficial to me. It's beneficial for both parties, but based on what my buying criteria are, it helps me make a better offer because it guides them towards exactly what I'm doing. So we was talking about the concepts that Alex Hermosi had, he references all the time about marketing strategies and different price anchorings and all this other kind of stuff. All of those marketing techniques and strategies are in full effect viable today because you can structure it as like an all cash offer, a partial seller finance offer, and 100% seller finance offer. All right. And ultimately, I want them to pick option two because that's the most beneficial for me, but also most beneficial for them because they get to walk away with money at closing and they get as close to their price as possible. But, there's always pros and cons and things are changing all over the place. So if you're not making offers right now with a seller financing piece or component to it, I think you're leaving a lot of deals on the table because sellers think that their property was worth what it was 12 to 24 months ago. And, they missed, sorry, buddy, you missed the peak of the market. And that's just not how it is right now. The tides have changed and we're having a little bit more negotiation ability and saying, holding fast on some of the things that we find dear and true and that we are not willing to give up and negotiate on. While maybe 6 months or 12 months ago, we would have been willing to be a little bit more lenient and kind of give more in order to get the deal, just because deals were so hard to find at that point in time.
Yeah, yeah, really good point, Tim. It all comes back to what we were saying, right? Like, if you want to do deals right now, you got to kind of be willing to negotiate. You got to be willing to kind
Yeah,
of work work with work with the other side, right? And it's coming out in a lot of ways. And one of the other things I've seen recently that's kind of changed from the from seller sentiment is over the last couple of years. You tell me if you think I'm wrong here, but over the last couple of years, it's been like get it under contract, and then you may not hear from the seller again until it's like, are we closing?
yeah,
It's like, but today, I mean, I get calls constantly. We have a couple of things under contract. We closed on a couple of things. I get calls constantly on how are we trending? How are we looking? Are we going to get to close? That kind of thing. Can we close earlier? That
yeah,
kind of stuff.
yep.
Um, that's another change. Sellers
That
are highly engaged through the whole contract process now.
That was happening throughout, one of the deals that we closed over the summer. I mean, I had a different relationship with the seller, though, so it was a
Yeah.
little bit more of a friendly conversation, but that is exactly the conversation. Those are the exact questions that kept coming up. It was like, "How's the debt?" "Is it locked in? Did you get a commitment letter?" "Are you approved for the loan yet?" "Where are we on closing? Are you gonna meet the timelines?" And, yeah, it's like, it was friendly conversation, but ultimately, as a seller, they were asking those exact questions over the summertime.
Yeah, yeah, and by the way, the seller that said they haven't found one worth buying yet, it's coming. I'm not sure what your criteria is, but it's coming.
Yeah, absolutely. There's a lot of stuff out there that is worth buying. You just have to be willing to make the offer on what it works for you and walk away. If you're not making the offer, then you're never going to buy anything. So I hope you're at least putting in an LOI on those deals because one thing Tim and I like to say to each other is everybody gets an offer. And there was actually something on Twitter we were talking about, and I said everybody gets an offer, but I put in quotations that fits my buy box, right? And unit count and
Yeah.
markets, et cetera, and so forth. Properties that do meet my buy box, but are war zone properties or in bad areas or whatever, they don't get an offer, but everybody else does.
Yeah, yeah. Hey, and here's one thing I would say, Michael. I agree to a point. I also think that um, there's going to be a lot of opportunities right now with the uncertainty. One of the things about uncertainty is it makes people scared because kind of like when things clear, right, it makes it a lot easier to know what you are going to be managing towards. But if you have experience and you know how to manage through and be ready to pivot and things like that, and you're willing to go after deals right now, I think there's going to be some really good opportunities for folks who can get things now,
Hmm.
even in the face of like unknown with rates and unknown with recession trends and things like that. It's one of the things Michael talk about, honestly, is how he manages his assets through recessions and the type of assets that he looks for going into a recession. So
Oh yeah, that's definitely one thing that always, skips my mind, but it's definitely a valuable conversation piece of what types of assets are you going after during a recession trend. And another thing I wanted to follow up with that on Michael's comment was that a lot of sellers are willing to be a little more flexible on the purchase price because they don't know how much further down it's going to go. So they're willing to lock in whatever they can in their equity today and have a known number. There's there's confidence and there's safety in having a known number because there's less variables now, right? They can calculate what the returns are going to be. They can calculate what they're going to do with the money. They can calculate a whole lot of things. If you think about it with that perspective, that if they don't have an offer with an accepted contract currently, then they have a potential unknown question mark of how much further can it go down, or do I want to exit while I can, capitalize on this equity, make my money per se, instead of trying to, squeeze it out for everything possible, be liquid, and then look at buying a property, in the next couple of months or in a year or something like that, and just being liquid and able to kind of move quickly on an opportunity when it comes up. So have that mentality there, like, hey, like they would rather know what they're going to exit it for than have the unknown variable of the markets can continue to go down and I might not be able to get this price 3 or 6 months from now.
yeah, yeah. So it's there. You just gotta, if your underwriting works and the variables that you're putting in there are known to you, or you know how to manage through them, man, just don't be afraid.
Yeah. Yeah.
Um,
And then another thing is like, be aware of the debt that you're putting on the property. I mean,
sure. Yeah.
we're still buying stuff with bridge loans, right? We'll be honest there. But instead of a 24-month term, we're looking for 36-month terms to give us more time. What we saw in 2008 and 9 was that it crashed in 8 and, not 9 and 10 and then started to rebound in 11 and 12. So if you have the time available, then it enables you to be able to wait out the storm of the variable rates and capitalize on the continued inflation because with inflation rents are going to continue to rise. So you would hope that in effect over time that the rising rents keep up with inflation and therefore kind of offset the difference in the rates that you're seeing. So there's a little bit of kind of a game there, but if you understand the mechanics of how leverage works and how the rates are offsetting of each other, and you put the time component in with it as well, you'll be able to kind of, even though it is still speculating, you're still speculating what could be positive in the future.
Yeah. Here's one, Julie. Good morning. Great to hear from you. Actually, Julie and I have been chatting some this morning on text message. But guys, like, take a listen. Definitely take what Julie's saying here, and listen to it because she's not wrong. And we'll go back to just as recently as COVID in 2020. You know,
Tell everybody what Julie does, so the ones that don't know what Julie does,
yeah. So
and why they should
Julie,
take it important, like why
yeah.
take
So
it seriously.
so Julie's a real estate professional in the Triangle area in North Carolina. She's done everything from land to single family to multifamily development, you name it. and she's well connected with a number of developers in the Triangle area. Great person to know. Don't try not to blow her up too much, though, guys. She's I try to keep people in my back pocket, right? Don't like to share them too much.
As you're putting them on a Facebook Live that anybody could see.
I know the irony is thick, isn't it? But
Yeah,
hey,
right.
guys, like Julie makes an extremely good point here. Go back to 2020 and think of one of the biggest cities in America, right? People were scared of a metro called New York City, and yeah, people were fleeing. And I will tell you, the folks that bought when other people were fleeing out of that market, they're happy as hell right now. They are doing really, really well. I think New York City set a record for average rent price over the last year.
No
Um,
way.
yeah,
I didn't see
uh,
that.
yeah. I think they and I got some buddies in one of the groups I'm in who own some property in New York City. Their landlords, sorry, their property management was calling them saying, if you have leases coming up, push them as high as you want to push them. They're basically saying rents are escalating quickly. Um, and so again, that's a market when people were scared. That's a market where the people that went in and weren't scared, they're doing really well right now. So don't be afraid. Don't be afraid of big markets, right? If you know what you're doing and you know the market and you believe in it and your underwriting solid, don't be afraid of it.
Yeah, no, I agree with that. It's control if you know the variables, right, and you put it into your underwriting. Because ultimately, I like to say this all the time, is that underwriting deals is like algebra. You're always solving for X, but in our world, as real estate investors or syndicators, your X is your investor return or your return on money, right? Put it that way. If you can put in all your known variables and update your underwriting, which is a fluid document that changes over time as you continue to get more and more information on a particular deal that you have under contract. If the deal still meets your criteria, no matter what the rates are, then buy it. Something that I learned to adapt recently was marry the price and date the rate, right? Because the price is going to be forever, until you sell it. But the rate, you can always refinance later, and as rates continue to change, hopefully be more favorable in 24 months or something like that from where you purchased it today. But it's something that we know is cyclical. They go up and down. The Fed doesn't typically pull rates like this as high, as fast and as high as they do. But if you also look at historical graphs and charts, whenever they do spike the rates on, they end up dropping them down over time again as well. So buying something now at a high rate doesn't mean you're going to have that high rate for the next 20 years or whatever.
Yeah, yeah, completely agree.
I mean,
Completely
think
agree.
about how many single, taking out the commercial side of things, which have 3, 5, 7, 10-year balloons. Um, Look at it on the single family side. How many people do you actually know that have one single family loan on their house and they have bought it 30 years ago and they pay it off, just never refinancing? Very, 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 very slim amount of people, right? People always typically end up refinancing it or selling it before their loan comes due, or being able to pay it off entirely. I mean, it's a very finite amount of people that do that, and that's where reverse mortgages and all that stuff comes into play. But it's just misconception that that the big corporations are feeding you, is that you buy a 30-year rate and you're locked in for 30 years. Well, yeah, your rate is locked in for 30 years, but that doesn't mean you're going to live there for 30 years, and doesn't mean you're going to have that loan for 30 years, right? So
Yeah.
if you take that out and you say, hey, like, I always have options available to me in order to better my financial position, use them.
Hey, and by the way, marry the what did you say?
Marry
Marry
the
the
price and date the rate.
date the rate. I actually think, and here's where I'm going with this. I actually think that I may marry the rate that I have on my house right now. Speaking to your point, is
Oh,
my rate is it's under 3, guys, under 3%.
wow.
And for 30 years, I always thought when I move, I'm going to sell this, take the equity, move it to somewhere else. And now I'm like, I don't know, man. I might just keep it
Yep.
at that with that rate. I may just keep it. Um, and here's where I'm going with this. Like that's one of the reasons why I think single family right now is there's some opportunity there, guys. I know we talk about multifamily a lot, but multifamily can mean a number of different things depending on how you look at it. And Julie and I talk about this quite a bit. Um, is, we're purchasing some stuff that's in the single family range right now, and one of the reasons why is there's a lot of people like me who got in under 3% and may just keep their house for a very, 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 very long time. Um, in fact, almost everybody that lives right around me, and I live in a fairly large neighborhood, is in the same boat. And I think that is going to cause an even bigger strain on single family housing
Mhm.
over the course of the next 10 to 15 years. Is that less and less people are going to be willing to give them up. Um,
Mhm.
and then on top of that, you got a lot of institutional buyers going in and buying just swaths and gobs and gaggles. I don't know
Well,
any other words of
would you
single
say that
families.
it's possible that the banks could call the note due because of the locked interest rate versus current interest rate? I don't know
Um,
if there's any, like, terminology or anything in the contract, and maybe somebody that knows single family mortgage loans better than I do can comment on that, but, yeah, I'd be interested to know, like, if
because
rates get to 18% and you locked in at under 3, can the bank call your note due and say, "Hey, actually, no, we can't honor this anymore?"
wow, I don't know about the legal ramifications of that one. I know about the PR ramifications of that
Oh,
one.
yeah, the PRM, yeah, yeah, that would be awful for that, but, yeah, I'm wondering about the legal side of that. I mean, because banks call notes due, typically for non-payment, right? But, if you see such a large spread between the locked interest rate versus, inflation and current interest rates, and, like, they look at it and, like, it's gonna save us money to call this note due rather than, see it in full term. Is that a possibility? But
Yeah, I don't know. I mean, I have my opinions on some of the larger banks out there, but I don't know, guys.
yeah, interesting. I don't know.
Yeah.
Good conversation though.
Well, and hey, like banks don't always just call it due for non-payment. There was a time not too long ago, in 2009 and 10, when banks were calling things due because they thought you might not pay.
Yeah.
You
Oh,
could
yeah. I
be
remember reading that.
you could be current and paying, and they'd call and go, "Nah, you borrowed 200. It's worth 40. We think you're going to stop paying, so we're going to go ahead and preempt this whole scenario and call it due." That happened, uh,
Yeah.
and
Yeah. So who's to say that that doesn't happen because of rates?
yeah, I don't know. Boy, that would be that would be a PR nightmare, man.
Right. 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 But who? Yeah. Whatever. I won't go into that. Right. Because there's a lot of things. But anyway. So yeah, we're seeing a lot of change in the market, and we're just that absolutely happened. Yeah.
I assume you're talking about back in nine
I
and
think,
10.
the
Yeah,
calling notes due because we think you're not gonna pay, but, yeah, I think that absolutely happened. It definitely absolutely happened. We can look at the history books and know that it did, but, yeah, so I just, kinda getting back to, the original topic of this is, like, what are we seeing in the change in the markets is you just put your offers out there, right? You might feel like you're, uh maybe you're not submitting a high enough offer, but ultimately, like, there's still a discrepancy between seller expectation and buyer expectation. And buyers are getting more up to date information on what their acquisition costs are going to look like, and holding costs are going to look like. Sellers are still looking at what their current financials are and not understanding from the buyer's perspective what it's going to cost to hold a property. I just had that conversation on another property I made an offer on, where they weren't paying a property management fee and their interest rate was ridiculously low. I'm like, well, I just can't get that kind of debt, and I have to pay a property management company. Therefore, the property is going to be worth less, even though the NOI shows it currently. It's not going to show it in the future, and a bank is not going to underwrite the bank is not going to underwrite your portfolio at a 25% expense ratio when they're going to look at it and say, hey, like, it's going to be at least 45 to 50%, because their perspective is, if you default on the loan, what is it going to cost me to hold this asset? Right. And so that's why they use that conservative underwriting there. Um, so yeah, so a lot of interesting change going on. Rates changing constantly. The Fed meeting in another 7, 8, 9 days, something like
yeah.
that. They're talking about the probability of another 75 basis point increase is like 95% of this chance at this point. So we can pretty much expect another 75 bips coming in on the rates. And then I think there's another expected meeting in November and or December. There's one or two more meetings after this one that's coming up. So we can absolutely see some more rate increases coming in. And from what I've read, people are predicting that the rates will start to either stop increasing or actually see some kind of decline in Q1 or Q2 of next year. So obviously, all speculation. Nobody knows what's going on, except for the Fed, I guess.
Yeah.
uh, but interesting to see and talk about like what we're seeing in the market and how we're using this information and just what we're aware of currently. And that might change next week, and the week after that could be entirely different. The election coming up on November 8th. So go out and vote if you're registered to vote. You should be registered to vote. Make an impact there if you can.
Yeah, so guys, I can't agree more with what Tim said. And one thing I would add to this too is if you're gonna like read stuff, really dive into it. Don't just read the headlines these days. There's a lot of like shock and awe going on out there, but then when you actually read the headlines, um, the information in the articles a lot more telling and not quite as alarming as the headline would make you believe it is. So get in there, and because for example, you'll see things that's like the market's going to hell, and then you read it, and it's like, yeah, these things are struggling, but here's three places where you should be looking, and one of
Right.
the things they're talking about is physical assets. Buy physical assets right now, and by the way, real estate is one. Um,
Yeah.
um, so yeah, do yourself a favor, just stay educated.
Yep. All right, guys. Well, that's all we got for today. I hope to see you guys at our race car and real estate event November 18 and 19. If you want to talk more about this kind of stuff with people that are far more experienced and smarter than we are, hope to see you guys in the room. It's going to be a really fun event, driving 911 Porsches on the track with an instructor and a lot of great networking. So I got nothing else. Tim, you want to take us out?
Yeah, man. So Dan, looking forward to seeing you there, man. Can't wait to see us both try to get out of that damn car. And and
Oh, Tim's going to buy it.
yeah, I'm buying. So guys, see you in Atlanta at the race car event, and take care and have a great week.
See you later.